Hey, welcome back. We are here with our special guest, Jack Colston from West Capital Lending. He's a purchase specialist, and we brought him on to talk to you guys and teach you a little bit of an overview of purchases for your first home or second home or maybe investment home. Jack has been in the industry for many years. He's an expert in purchases, and we've asked him to share his knowledge and his insights and experiences with you so that you guys can all benefit. Hey, Jack.
Perfect. Hey, Peter. Thanks for having me today.
No problem. We're glad to have you. Jack, why don't you tell us a little bit about yourself? How many years have you been in this industry? Obviously, you work for West Capital Lending. And yeah, just give us a rundown of who you are, man.
Yeah, so I've been doing this since straight out of college, actually. So coming up on about 13 years of being in the industry. The majority of the time has been mainly focused on purchase, with some refinance in there. But it's a great profession, great career. I enjoy what I do every single day because we're truly able to help people, especially on the purchases. Having someone who has no idea what they're doing and what they want to, do with a new purchase, and walking them all the way through to the finish line, and the day they get their keys in hand for their first house. There aren't many more rewarding things than that.
Awesome. Yeah, I would consider you a veteran. Anything more than 10 years, you got a lot of experience under your belt. You've seen some cycles, right? You've gone through the COVID era. Um, have you experienced the '08 crash?
So no, I was in college at the time, so thankfully didn't have to worry too much about income at that time. But right when I got licensed, times were good. It was 2012. Times were good. All of a sudden, rates ticked up a little bit, and the company I was at went from 60 people to 8 people overnight. And it was a really good learning experience because at the time I didn't have any bills, didn't have a family, and I didn't have this amount of money that I needed to make each month. So seeing, hey, it's a true boom and bust industry. So
Hmm.
enjoy it when it's good, but be smart, and you have to grind when it's tough.
Yeah, you have to grind when it's good too, right? So you prepare for
Oh,
the
yes.
tough, yeah, the eventual toughness that's going to come.
Right? Grind when it's hard, grind when it's easy.
Yeah, never stop working, unfortunately.
Yeah, yeah, unfortunately.
Yeah, so Jack, is there a region that you specialize in, or are you like across the US?
Yeah, I'm across the U.S. At the time, I'm licensed in 19 states, which is a really cool thing because I'm able to help someone buy a multi-million dollar house in California. But then I'm also helping people buy a $125,000 house in Oklahoma, or Ohio or Michigan. So I enjoy that aspect of, instead of just being super regional and only dealing with a certain clientele, of anyone and everyone, I'm able to help across those 19 states.
In your conversations with your clients, I'm sure you're talking to, dozens of people on a daily basis. Is there a number that people are kind of waiting for in terms of interest rates? Like, you know what, Jack, I'm gonna wait till it gets to like four, or I'm gonna wait till it gets to like high threes, and then I'm gonna go back into the market. Do you hear a lot of that, or is that number not
No,
relevant?
for some buyers, maybe. Maybe they have this idea of like, there's no way I'll buy a house with a 7% interest rate. But when you're going from renting to buying, it's just, do the numbers make sense or not? Because what's your interest rate when you're renting? It's 100%.
Hmm.
You're All of your money is going towards interest, and you're just paying your landlord's mortgage. So if the numbers pencil out and it makes financial sense, then rates when you're buying your first house, they shouldn't matter. Sure, it'll affect whether you can buy, if you're buying a $400,000 house or a $500,000 house, but waiting until someone is trying to get a 5% rate, what's the difference between a 5% and a 6% when you're trying to get into your first home?
So we're talking about a specific situation, first-time home buyers. you shouldn't really pay attention to the rate. It's more the cost of the home, right? The overall price.
Yeah, it's all about the payment.
Mm-hmm.
Even the price at that point doesn't matter. We need to sit down and we need to look at your finances and figure out, hey, you can afford $3,000 a month.
Mm-hmm.
Now, what does that get you? Is it a house in your area that you actually want to live in? How do these numbers pencil out? And that's the only number that should matter when you're looking to buy, because interest rates you can always refinance. Sure, the same 2 years ago when interest rates went up, it was date the rate, marry the house, and that hasn't really panned out. A lot of people are still stuck in that 7.5%, 8% rate when they thought that they were going to be in it for 6 months, and what all these mortgage gurus were telling them, hey, it's going to be a short-term thing. So don't look at what could be. It's in the moment. Hey, what can I afford? What is going to be comfortable for me and my family on a monthly basis? And then that's really how you're going to decide, is the time right or is it not?
So you're more on the side of don't try to time the market, whether it's going to go up or down. If status quo, is this going to make sense for you in the long run?
Exactly. Yep, 100%. Because, I mean, sure, we can look at '06, '07, '08, what happened after that. But ever since, let's say, 2012, if someone was waiting on the sidelines for rates to get a little bit lower, what has happened to home prices in that amount of time? I bought my house in 2020, early 2020, right before COVID hit, and I should have bought two. Like, it's crazy that, how much they appreciated in that amount of time.
Yeah.
And it wasn't like I was sitting there waiting for a certain interest rate to pop up. It was for me and my family at that time. We were tired of paying our landlord's mortgage. We wanted something of our own, and it was the best decision we ever made. Every year since that's happened, that same story is out there. Whether you bought last year compared to where it is now,
Mm-hmm.
home prices are a little bit higher. So if the numbers pencil out, waiting for rates, waiting for the big crash that everyone's been saying for that's going to happen over the last 10 years, it's not realistic. And one thing that people forget about is, I talk to a borrower and they say, hey, home prices in my area are 600,000. I know they're going to crash. I'm going to wait until they're 500,000. Do you think that borrower is the only person waiting on the sideline?
Mm-hmm.
Absolutely not.
Mm-hmm.
There's everyone else who's sitting on the sidelines. So let's say home prices start to go down a little bit. All of a sudden, that house, instead of being worth 600, is now worth 550. All these people are coming out of the woodworks, and now it's a bidding war.
Mm-hmm.
Now you're having to waive your contingencies on that house. Now you're having to go over asking, and now you're back at 600 again just to try to get into that same house. So the idea of waiting for the market to crash and home prices to be a little bit lower than they are now, on paper, awesome. But real life isn't that. There's a lot of people on the sideline. A lot of investors are just waiting for a little dip, and they're going to start swooping up the houses again. So it all comes back to timing of you and your family and your individual scenario. It's not the greater market. If you're talking investment properties and you're talking your third, fourth, fifth house, sure. Numbers really need to pencil out then, and you need to really figure out, is this going to cash flow? Is this going to make sense? But when you're going from renting to buying your first place, it's there's no better time to buy than now if it financially makes sense.
You mentioned that you purchased your house back in 2020. Did you have to put like a standard 20% down, or how did you go about that? Because I know like people who have not yet really dug into it, they're sitting on the sidelines because they feel like they don't have that 20% ready yet.
Yeah, so when I bought, thankfully I was able to put 10% down, but it still was not the full 20, so there was mortgage insurance on there. Um, when I talk to clients who are trying to decide, hey, is now the right time or should I continue to save up? When we really look at the numbers and you get down to it, having under 20% down payment, sure, no one likes to pay mortgage insurance, but it really doesn't move the needle as much as you think it does, especially when you look at the payment difference over that, whatever percent that you think you're going to be able to save up in that amount of time is. So if someone is able to save up an extra $20,000 over the next year, what is that actually going to do for your monthly payment if it's applied to the down payment? It doesn't do much because a mortgage is so long, over 30 years, it doesn't move the needle compared to, just getting in. Once again, like I said earlier, it all comes down to timing of each individual scenario. So if it makes sense on the monthly payment, whether it's 3.5%, 5%, 10%, 20%, whatever it is, it all comes down to that monthly payment because that's the only thing that matters once you're into your house. So maybe you're not going to be able to get that excellent house that you really, really want to, but for someone looking at 3.5%, it should be their starter home. So just getting into the market, getting something that's your own that you can start building appreciation on. So get in the market now if it makes sense. It is extremely rare now that I help someone, especially if it's their first house, buy it with 20% or more. It's 3.5%. It's down payment assistance or maybe 5%. It really is not that 20% because when you compare the payments between the two options of 3.5%, 10%, or more, like it does not move that needle on the monthly payment, and that's the only thing that matters when you're looking to buy. With the lower down payment, the mortgage insurance is there. It'll eventually drop off, or you might have to refinance out of it. But at least at that point, you're going to have your own house, and you're going to be able to get that appreciation growth over time.
Yeah, and then sell the house and then use that money to get into the next house, right?
Exactly.
I'm sure you've helped hundreds of first-time home buyers. And with that experience, have you seen how they've leveraged that first-time home purchase into their growing family's needs for the next home? And what did that scenario look like?
So, yes, absolutely ran into that to where they're able to get into their first house with an FHA 3.5% down. Very affordable, lower interest rates, you can get into the market. And then when the time comes and they need that bigger house, they either, do what's called house hacking, where they can then keep the first house and move on to the second house and potentially use the FHA loan again. There's some stipulations there on whether you can have two FHA loans or not, or at that time you can go conventional. But using the 3.5% is the easiest and truly the best way for most first-time home buyers to get keys to their first house.
Because I had clients where they bought that first duplex, right? Because it was a starter home for them. And it's not that they plan on being an investor, but they ended up leveraging that 3.5% FHA loan to get that duplex. And then that second unit ended up paying for most of that mortgage for him. And then from there, it house hacked. He got married eventually, and then he bought a single family home with 3.5% down. And now he had two units that ended up paying for that mortgage and part of his primary home, and then helped him facilitate into that growth. And then from that point, he took that home when he had his second kid, bought a normal conventional home at that point. And then he had 3 properties generating revenue. And he never once looked at it as an investment. It was more of it just helped him naturally progress into home ownership. And at the end of it, it turned into passive income for him. And since then, that was starting from back in 2018, and now it's 2025. So he's got a few properties under his belt, So it's
and he didn't set out to be this real estate investor.
No.
It just happened.
Not at all. And then it's just because, like he said, that conversation, it was, are you comfortable with making that monthly mortgage payment? Because for them, it was, this is my house. It's either I'm paying rent or I'm paying for a house with a mortgage. And one behold, in like a handful of years, it's multiple properties now, right? And he's the inadvertent landlord.
Oh, that's really interesting. So, this question came up in my head right now. Jack, do you have like a hack or like a secret tip that you could provide on how to navigate these really high interest rate environments?
Yeah, great question. So I actually have a real life example that I just helped a borrower out. She was buying her first house. It was in Washington. The market itself was cooling a little bit in the area, so the house had been on the market for about 45 days. And I was talking to her about different price points and what she can afford. And one thing that I brought up was if a house is listed for, let's say, 400,000, instead of going and offering 385 for that house, let's offer full asking, but ask for $15,000 or $20,000 in seller credits. So what she did is she was able to offer a full 6% seller credit, and they ended up accepting it. So we had about $20,000 to play with, and the loan program we ended up using was a 2-1 buy down on the interest rate. So the interest rate I was able to get her was at a 5.99%. With a 2-1 buy down, what it means is the first year of mortgage payments, it's at a 3.99. The second year, it's at a 4.99, and then it'll go to that 5.99. So when we're looking at the numbers on the payments, it's a whole lot cheaper for her, especially those first 2 years, having the seller pay for that buy down compared to the small difference in payment it would have been if she would have just asked for a $15,000 off of the purchase price. So using something like that, it moves the needle on the payment drastically compared to $15,000 even over a 30-year payment.
Nice. That's a really good move, Jack. And only someone with so much experience in the market can have that in their back pocket as a strategy to use. And it really, like you said, it doesn't really matter what the environment is. There's always ways to get into a home, right? With a strategy that makes sense for the borrower, whether they're a first
Absolutely.
time or an investor or whatever the case may be.
Yep, absolutely. And that's why it's crucial to have a good loan officer who knows what they're doing, but also a really good realtor who knows what they're doing and knows the market and how to approach these situations to make sure you as a buyer are getting the best deal for you and you alone.
Yeah, let's pivot over to how does someone get into a house. So there's something called pre-qualified and just qualified or pre-approved, right? So could you shed some light on the differences between those two terms for someone who is not familiar with it?
Yeah, absolutely. So you're spot on. There's two types of letters or qualifying aspects that you can get when looking to buy a house. So you can get a pre-qualification letter or you can get a pre-approved letter. Pre-qualification letter, truthfully, isn't worth the piece of paper that it's even written on. It can be, hey, I spoke to this lender and I told them what my income was. I told them verbally how much money I have in the bank, and I told them what my credit score is, and they spit out a pre-qualification letter. Most realtors and good realtors at that won't even take time out of their day to look at an offer that has a pre-qualification letter because it's not backed by anything. Pre-approved letter, on the other hand, it should be a true fully underwritten pre-approval. So credit was pulled, income documents were reviewed, assets were reviewed. That borrower is truly ready to go into contract and have no issues with underwriting. So having a pre-approved letter, it gives confidence in the realtor, it gives confidence in the sellers to accept your offer. That's the only thing that you should have in your hand if you're serious about buying or if you're serious about getting your offer accepted. You need a true pre-approval letter.
So like pre-qualified is kind of like my mommy and daddy taught me I'm special, and pre-approved is like I have the credit card with me and it has an open line of credit.
Yeah, the T-ball participation trophy where everyone's getting a ribbon, and then the kid
Yeah,
that's hitting home runs all day long and he's winning games. It's
yeah, yeah.
yeah.
So what we want to coach and well, not maybe not coach, but what we want to tell people who are thinking about getting into the market, get your pre-approvals first. Get all that done,
Absolutely.
taken care of.
Yep, absolutely. And then those you want to have a fresh pre-approval letter in hand to where if you get pre-approved today and you're sitting on the sidelines a little bit and then you end up going and submitting an offer 6 months from now, it's dated. It doesn't really mean anything. So when you're getting real serious about submitting offers, you'll get pre-approved, and then that lender can update those letters as you're submitting offers on homes. And I tell my clients the same thing. It's like, hey, if you go out and you want to submit an offer on a house this weekend, shoot me a note. I'll refresh that pre-approval letter to show that it's hot off the presses and you're serious and you're good to go.
How long can you let a pre-approval age before it gets old or stale?
So I don't date them longer than 30 days. You want it as fresh as it can be because you don't want to turn in an old pre-approval letter and have it dated a month and a half out, and that's the reason the seller doesn't accept your offer. And there are sellers or there are realtors that'll say, hey, a lot can change in a month and a half. This person might not have their job anymore. They may have spent all their down payment money on a car that needed to be fixed, whatever it is. So let's go with the one that has an updated pre-approval letter.
So like when you refresh a pre-approval for a customer, what should be the process in your eyes for that?
So it depends how old it's been since credit's been ran. And that's the big question, is the time between when credit was ran and when it is today. If it's been longer than, I'd say, a month and a half, 2 months, I'll probably do a soft credit pull at that time to make sure nothing has drastically changed. And that's when a good open dialogue between the loan officer and the client is crucial. It's like, hey, I'm giving you this pre-approval letter. You can't go and buy a new car. You can't miss any payments. You can't go out and buy new furniture on credit for your new house. It's like we need everything to stay exactly the same. Don't change jobs if you don't have to. It's like everything needs to be the same between now until you have keys in hand. Because unfortunately, people don't take that seriously. They'll quit their job 3 days before closing, and the processor calls for a verbal verification of employment, and it kills the deal at the finish line. Someone goes out and I wish this wasn't the case, but I've lost deals because of this. People lose out on homes where they are so excited about their new house that they go buy $15,000 worth of new couches and appliances on credit. And their debt to income ratio was already so tight that an extra $200 a month prevents them from buying the house. So now they have all this new furniture that they bought for no new house. So the open dialogue of, hey, here's what you can or cannot do between now and when you actually buy is crucial.
That's really unfortunate that you're so excited that you just derail your own dreams of getting yourself into your house. That, oh my gosh, if that was the husband and the wife caught wind of that, that's you're gonna sleep on your own couch.
Yeah, and unfortunately, it's not one-off scenarios. It's happened many times for the new furniture, the new car, the changing of jobs, whatever it is. It's tough, and it happens, unfortunately.
It does. That's super unfortunate. Jack, do you have any other like really common mistakes that borrowers make? Something that, if every borrower followed this rule of thumb or this piece of wisdom, it would just improve their chances a lot.
Yeah, the biggest thing is not getting anything new on your credit report. That's it. Because most of the time when you're buying a house, some people stretch themselves to where the debt to income ratio doesn't have a lot of wiggle room. So you add in a new credit card, the Macy's tells you, hey, if you sign up for a credit card, you're going to get 15% off. And they do it, and that payment throws it all out of whack, and we have to rush to kind of figure out the numbers to make it work at the finish line. Biggest thing, don't get new credit, and don't change jobs if you don't have to. Because from the moment your credits ran, all the way until a couple days before closing, the lenders are always doing these soft credit checks or looking into inquiries on your credit. So they want to make sure that you're not going out and you're not adding a bunch of debt, so you can still qualify for the house.
It's that the underwriter, I think, requests not a full check or soft check. They ask for supplements. Like they'll
Exactly.
pay $50 to get a credit supplement to make sure there's no trade lines or the balance didn't change. And and it's like what Jack said. I've heard of so many horror stories where it wasn't even a new application for credit. They went out and used an existing trade line to acquire furniture and a dishwasher and refrigerator, all these appliances, and that threw them out of whack because that supplement went from a $50 payment to like a $500 payment.
Yep. Very unfortunate.
All right. Well, Jack, we really appreciate you coming on today and sharing, the wisdom and insights that you've accrued over the 13 to 15 years in the industry. We would love to have you back on the show again. Maybe we can go into some different, more niche topics. Today was just like a broad overview, and I think we mainly hit on first-time homeowners or home buyers, right?
We did, yeah. It was a great conversation. I appreciate it.
Yeah, absolutely. We had a lot of fun, and we hope to see you next time. And for everyone else that's watching, we hope you guys got a lot out of it. And if you have any questions about your first time buying a home, please hit us up. We have Jack's contact information, and his socials will be linked in below. Give us a like and a sub, and we will see you guys all next time. Bye.
See you guys.